so, so welcome everyone to Heels on Fire session. We had a little bit of a break there. I apologize that my presenter had a last minute change, unexpected client come in, but we have rescheduled him for this month. So that's awesome. So Heels on Fire is a presentation of RE Investing in Heels. So this group is for women to empower other women to help you ditch the 9 to 5 and, really get that help get financial freedom through real estate investing. I am Debbie Balfour, in case nobody knew that. And I have 4 years of real estate investing. So I still consider myself a little bit of a novice investor. Like I'm between, I'm there, maybe intermediate, but I still remember what it's like to be novice. And so I like to, ensure that I'm sharing, the things that I went through there. I have a portfolio right now of 6 properties. I had more at one point, and I've sold. I have them in BC and Alberta. The majority of them are in BC. I'm a dedicated success coach. I empower individuals to achieve financial freedom. My expertise is quite vast. Um, I've got joint venture partnering experience, both on the from a financial partner and a working partner. I work with creative different financial strategies. I've done BRRRRs. I maximize my returns through various rental strategies. So I do long-term, short-term, and mid-term. I'm also invested passively in private lending and in private equity, apartment funds, land development, and syndicated mortgages. And my coaching program starts with mindset and provides actionable steps, an actionable plan with bite-sized learning, giving you sequential actionable steps that keeps you going, gets you on your way as you're learning, and moving, and get you unstuck and moving in your business. So my coaching is on mindset, productivity, and real estate investing. So not just real estate investing, because I find if you need the combination of those to keep moving forward. And my clients are able to just to ask questions of me between sessions through private messaging, so that they can get unblocked. So they don't have to wait for a one-on-one with me or a group session to get their questions answered. They can pop it out there and then keep moving. Um, if this session is being recorded, it is on live too. And if you would like this session in your mailbox going forward, so that in case you miss any sessions, you'll always have it. I'll pop in the chat. I need to find that one for you. And I call it Heels on Fire in your inbox. And you can just sign up. If you've already signed up for this, you don't need to do it again. You're already on the distribution list. But if you haven't, just in case, you'll never miss another session, because you will be sent it right away into your inbox after the session. So you don't have to worry about that. Today, we have our wonderful guest today, Joe Tablin, and Joe has been in the financial industries for over 10 years, and he's been working with entrepreneurs and investors to grow their wealth. He's licensed in both BC, Alberta, and in Ontario, so he can really help your portfolio grow from that perspective. He is also a real estate investor. I think he's a novice in estate investor, but he understands that mindset. So he's here to help us bridge that gap between how can we use financial services that he provides to help us. In particular, we're talking infinite banking, which I know Joe does not like that topic, and that word for it, or that terminology, and he'll explain why during his session. But he really he's going to help us bring those two together and show us some and as I was talking, creative financial strategies. This is one of those creative financial strategies that you can have in your toolbox. Yeah. So I will stop sharing now, Joe, and I will hand over to you.
Perfect. Thank you so much, Debbie. I really appreciate you having me on. Um, thank you everyone for coming by and listening to what we have to say here. So technically, we're going to be talking a little bit about infinite banking, and in terms of the words, obviously, it's one of those hot topics that are going on right now, and I'll tell you exactly what it is, who it's for, and we can go from there. So I'm just going to share my screen here, and give me 1 second. Okay. I guess everyone can see my screen.
Yep, maybe you can just put it in presenter mode.
There you go. Perfect.
Yeah.
Perfect. So today we'll be talking about infinite banking and specifically for real estate investors and private lenders. And you see, just a little bit about me. Like I said, I've been in the industry for over 10 years. Actually, it's 11 years now. I didn't even realize it's 2023. So I've been in it for 11 years. 2018, I started a company called ClearPoint Wealth Management Incorporated, and we serve a lot of actually more corporate type of planning. So a lot of the times that what we do is we take a look at someone's corporate structure, whether it's in real estate or whether it's in their business, and seeing ways to minimize the tax inside those corporations, both actively and passively. We have different strategies, and obviously using infinite banking is one of them. And basically from there, we've established a pretty good name. So we do have accountants on board. We also have underwriters as well, specialized. So that way we can get the most favorable decisions out there. So in regards to professionals, real estate professionals, who is this for? Basically, what we're looking at here is we're looking at active investors and passive investors. So people who have stable incomes, because it's not for everyone. Infinite banking is basically for people who do have good, stable businesses, who do have good cash flows, and essentially want to be able to tap into that strategy in a more efficient way, more tax efficient way, but also I'll talk a little bit more about it in regards to getting it to work more than one job. I think that's one of the key things that we should be able to take away here. Two key takeaways is really if you can make your money work harder by doing it more, investing it and putting it into more than one thing, you'll be able to maximize the potential of that money and also control and compound. So those are three key words I want to stress today. If you can remember that, that'd be fantastic. But again, we're looking at people who are looking to develop something beyond the traditional norms. Our society is based on I guess, the old way of looking at things. RSPs and TFSAs have been around, or RSPs have been around since 1957. And all those, they're good for certain positions. They're not good for everybody. And the reason being is because I don't know about you, but I don't really look at retirement as I want to make less in retirement. That's why we're in real estate. So that way we can grow a portfolio. So that way we can actually maximize the retirement that we want instead of settling for what the government is really giving us. We're also looking at tax efficient strategies to enhance growth, but they're also concerned about liability issues. So liability issues really talk about tax as well as estate planning. Not many people look at estate planning on their real estate portfolios. There's two key reasons where I found a lot of my clients go into real estate investing. And the first one is that they want to create wealth. They want to create wealth, and so that way they can either retire or be of service in a different way. But for the most part, they want to be able to say, hey, I got 100 doors that's cash flowing me. And when I'm old and gray, I still have this money that's coming in. But secondly, most importantly, is the generational wealth. So generational wealth is the one that many people want, but they don't really take a look at it. So I've always talked to this. I've had a client actually that had 100 doors, and just based on their tax bill today, they can basically give out about 40 doors to their kids, but they have 100 doors. So why am I only going to get 40 doors, they say? Well, based on capital gains, based on your RSPs, based on your final tax bill and deemed dispositions, you're actually going to be paying more than what you make, which is not a very good thing. And their structure was not perfect. They had opcos and holdcos everywhere, and it was just a big mess. So we have to go fix all those things. And essentially, we're also looking at passive investors. So passive investors, a lot of the time, they're going to be your private lenders. So they're looking for ways to maximize their dollars, saying, hey, let's put it into private lending because I can get 15% and the markets the last year was minus. So if I can do that, all the better for me. I'm also possibly looking at private lending or as a passive investor, looking at 10, 15 years, and I want to either pass it down or take a look at my holding company or take a look at my structure, seeing how that works and how I'm going to be able to move everything tax efficiently. Sorry, just give me 1 second here. There we go. They also want to have access to the cash. So it's very important because if we take a look at traditional investments, we either have to take it out of one entity and put it to another, or we have to collapse that all together. So we'll show you a way that we can actually do both and maximize your dollars. And then obviously looking at most optimal strategies here for tax. So the big problem that I see with, oh, pardon me. I went a little bit ahead, pardon me. So the key problems that I see when it comes to real estate investing is trying to multiply assets. So we heard the traditional way of say, hey, let's do a HELOC on our principal residence and then go put it in here. And then hopefully that's gonna do a refi and put it in here and here. So that's a really great way to do it. But when it comes to corporations, we're looking at tax, which is really high if anyone knows how passive investments work, but the rental income is usually taxed at the highest rate. In British Columbia, it's actually 50.67%, and Ontario is 50.17%, and Alberta is usually about 48. You can tell the provinces that I work in. But really trying to multiply your assets, going from one and trying to scale, you need to have at least some money in the bank so that way you can actually take advantage of, say, things like new water heaters or new different things, or take advantage of any opportunities. This is really going to help you out. I think the biggest one also is the eighth wonder of the world, which is uninterrupted compound interest. I want to stress the uninterrupted part because there's 4 key killers of compound interest. And the 4 key killers are, say, tax, fees, losses, and use. So if you don't use your money, keep it in the account. If you don't get any losses, if you don't get any fees, and essentially you don't get taxed on the account, your money is going to grow very, very fast. The only thing is, where are you going to put it if you have these 4 killers? We'll show you how to do that. I think the last part here is control, which is, for the most part, we put our money into things that we actually don't have a lot of control over. I don't know about you, but when you see your investments go up and down, do you have a reason, or do you actually know why they're doing that? Do you know why they went up? Do you know why they went down? Do you look at the markets every single day? Because if you are, then you are more in control of your investments. But for the most part, not many people are. That's why most people look into real estate, because of the fact that I can take a look at my property. I can take a look at, I'm lending Debbie the money for the property that I see, and I am talking with Debbie. And so therefore I know I have someone in contact of why my money is making money. and I have more control as opposed to putting it in the market. I'm not saying don't put money in the market, but I'm saying if you can put more into real estate assets or into other things like infinite banking, you actually have more control of the type of monies that you're working with. Okay. So remember these three keywords is control and compound. And I want to stress and actually. So when you take a look at control, you have the ability to, like I said before, you have the ability to control your money in a way that you can dictate what you want to do with the money. If you say, hey, if you're a private lender, you're going to say, I want my money to do 15% in 1 year, and Debbie's going to do it. And so, we have that agreement that after 1 year, when you do a refinance, you're going to give me 15% on my money on interest plus my capital back. You have that control because you can dictate what it is. Now, some people may say, hey, I want 25%. Again, you dictate what you want, but you have to also give what the market's giving you. So if you're 25%, I wish you good luck. Even though I hear some are 17% now in terms of private lends. Pretty crazy. So and is really taking a look at an asset, and I'll get to that in a second, but the last one is really compound. If you can compound your money without all of those 4 killers, you're doing way better than about 99% of people. Okay. So I don't know if anyone has ever heard of fractional banking before, but that is the type of banking that we have here in Canada, as well as the United States. How I can really explain it is that the bank, in terms of the bylaws and, laws in Canada, dictate that the banks actually don't have to give you or have to keep your money in your account. They actually have $0 that they can keep into your account. So if you put $100 in, they don't have to put it in there for you. They can actually use it on their behalf. So this little diagram states, if you have $100 into your savings account, and I'm being very generous here, it's giving you 1%, right? And you put it to the bank. The bank will take that $100 and disperse it into various types of accounts. So biz loans or business loans at 12%, mortgages 6%, line of credit, credit cards, all of that. So let's say an average, they're making 10% on your money. They're giving you 1, but they're making 10, 20, 30, 900%. How is that 900%? Because if you actually take a look at 1 minus 9, 10 minus 1 is 9%. But if you actually take a look at dollar for dollar and divide it, it's actually about 900% that they're making, which is pretty crazy what they do. So on top of that, they're using other people's money to give other people's money. So really, what are we basing our banking system on? The dollar has no backing. It has no security, has nothing. It used to be backed by gold. It used to be backed by gold. It used to be backed by different types of commodities, but the Federal Reserve got out of that a while ago, actually. So here we are printing money with no backing on it. So if we take a look at the perfect investment, we're taking a look at an investment that is safe. Basically, there's something called standard deviation, which rates how risky an investment is. It's actually from 1 to 18. So if I'll show you exactly what that looks like in a little bit here. But if we have a safe investment, but we also have liquidity, which means we have access to the money. So if we can have the money grow here and actually have it work here for real estate and private lending, that's a really good thing, because that way we don't interrupt the compounding inside this account. You also have tax deductions that are available. Use of leverage, which means you can actually borrow against the policy, kind of like a HELOC, and do other lending. Like I just mentioned, you don't have the interruption of compounding compound interest. And more importantly, the account actually doesn't go down. If you have an account that doesn't go down ever, contractually guaranteed never to go down, how much money would you not want to put in it? I assume you'd probably want to put as much money as you can if you had an account that never loses. And also it gives you an estate plan. Okay. So sorry, David, I don't see Facebook or anything like that. So if there are any questions, please, just let me know.
I'm checking, Joe. I'll stop.
I
Okay.
appreciate it.
It's quiet on Facebook Live, so
Yeah,
it's more
all good.
just the chat, and I'm looking
Okay.
at it.
Awesome. So is there a better way to protect your assets, have liquidity, multiply compounding inside the asset, and have it in a tax advantage way? So when I take a look at those three words, we take a look at the and asset. So there's two things. You can either have an or asset or an and asset. The or asset is kind of the old way of looking at things. So for example, I have a bag of cash here, and I can put it into bonds, I can put it into deposits, I can put it into real estate, whatever it is. I only am working that money once because I'm putting the money into whatever fund, into an RSP, TFSA, stocks, or whatever it is. I'm putting it here. And I basically am counting on this one thing to do the job for me. So in saying that, what we talk about basically having more than one job of doing the investment. Okay. So which one do we put it in is really the question. We don't know because it really is your cup of tea. But if we take a look at the savers mentality, I don't know if people realize this, but most people that I come across before going into any type of planning, they either do one of two things. They're either debtors or savers. So they get into debt and then they basically go all the way and save up to get back to zero. And then they get back into debt, go back to zero and go into debt. Or you could be a saver where you save money the traditional way and then you spend it. Or you can save it and spend it. Most people that aren't real estate investors think this way. So I'm going to buy a rental property and I'm going to save $200,000 over 10 years to go buy my rental property. And then I'm going to deplete it. And then hopefully I can save another $200,000 and then go buy another property and then spend it again. Very inefficient because again, you're using one thing and you have to work your tail off just to get that money. As we know, I don't know if you guys have heard about OPM, but if we can use other people's money to go into real estate, it'll be a lot more efficient and you can scale a lot faster. So this is the new way of doing it. So if we have an and asset, which means we can do this and we can do this. So if we can do both, we're making our money work way harder. So what we use is something called a tax-exempt dividend-paying whole life insurance policy. So that whole life insurance policy there's two components. We take a look at, say, like a house. So there's a component that goes into the insurance, so that way we can cover our butts in case something happens for our estate planning for our real estate. But also there's something called equity. And that equity is what we can borrow against for whatever we want. And so if we have our money into a life or put our bags of cash into an exempt life insurance policy, essentially we're putting it into an asset, again, that never stops moving. It keeps going up. It's given out a dividend every single year through world wars, depressions, recessions, you name it, it's given out a dividend to its policyholders every single year. And from there, what you can do is you can take the cash value or the equity inside your policy and loan it out and then go buy your real estate property. Or you can do it for private lending, or you could put it into cryptocurrency, or you can put it into stocks. Now, a lot of people will say, in terms of the infinite banking, a lot of people take a look at it and say, hey, if I have a fund that's making money here and I can borrow and go buy a car, and instead of me buying a car with the bank's money, I can use my own money. I can basically get it for free. And essentially not, because apparently unfortunately the loans do have interest. But with how we do it is we want it to be used for appreciating assets, not depreciating assets. Because if we use it for depreciating assets, essentially we can't use that interest for basically, we can't use it for as a tax write-off, pardon me. So if we can use the money just like a HELOC and put it into another rental property, and then from there we can also write off the interest, we're actually winning, because now we have tax deductions. Especially if you're doing it corporately, you have tax deductions, but also you also have another asset. So if you fix, how do you pay the loan back is really the big question that I get a lot. So what we're doing is we're going to do what we do. We're going to burr it, flip it, buy and hold it, whatever your heart's desire, whatever your strategy is for real estate, that is what we are going to do. That's what you're going to do. And from the cash flow and the profit, or if you're doing a refinance, what you'll do is you'll just pay back your loan and then start the process over. So it's really saying we can take one asset, borrow against it, and do what we need to do. So a lot of people use this actually for all of their savings. So when it comes to real estate, a lot of people are putting their incidentals in there. So if I need a 5%, 10%, what I'm putting in for my my roof contingency or any of that, instead of putting it in a bank account, I can make it grow inside my policy and borrow against it if I need to. And then once I do a refinance, I'm going to pay it back. If I'm putting any cash flows in, I'm putting it into my policy so that way I can borrow against it and do another property. So what you're doing is you're double dipping your money so that way you can maximize the gains and values. So I'll get into illustration here in a second, but really, sorry.
So Joe, I just want to kind of just do a summary and the hook there, that's to make sure everybody understands the hook there is that in the real estate, in the insurance policy, right, that money, say you got 100,000, that's the cash value on it, it is actually earning interest in there at 6%, say. And then, but you borrow money from that. See, but I can borrow that 100,000, and I can now lend it out and make, I don't know, even if it's a nice safe amount of 10%, I'm making 4% there. But you're not making 4%. You're actually making 10. You can make the 10% on it. Because your 6% is still growing as though you didn't even take that money out. That 100,000 is still growing at 6%.
Correct.
Right? And now you've borrowed the 100,000 and you're making money on that 100,000. And what Joe didn't say is that money, that 6%, the money that you borrow is simple interest. Correct. Not compound interest like the banks do. So that's simple interest. If you pay back that loan before the end of the year, you actually don't pay any interest on it.
You can pay less interest on it for sure, right? Because sometimes it is accrued daily, but you're still paying less. I think also a big component here in terms of the loan, didn't really get into it right now, thank you, Debbie, is that for one, the loan is unstructured, which means when do you pay it back? You dictate the terms that you pay it back. So you could pay it back 10 years from now if you wanted to, not put a dime in. Yes, it's accruing interest, simple interest, but that's okay. Because if I can make 6 and I can make, sorry, if I can make 15 on my 6, I'm laughing and I'm just recycling that money. Also, is that in terms of qualifying for the loan, there's only one big question. The big question is, do you want it in a check or do you want it in your bank account? Because of the fact that there is equity inside the policy that you are actually utilizing, they're obligated to give it to you. So contractually obligated to give you the cash value inside your policy is really key. And like I said, you don't have to have a credit check. You don't have a credit score. It's actually not on your books. So therefore, if you wanted to borrow this and also borrow some money from the bank, you can still do that without having to qualify for anything because you now have more money. And so that can actually help you in your debt service ratio because you have money working for you as well, right? So just give me 1 second. Sorry, my son just knocked on the door. So essentially what we're doing here is if we can do exactly what we do with real estate and take our money, and then instead of putting it straight to the real estate, we can actually put it into our policy, borrow against it, go buy a real estate, pay back our loans on the refinance. What we're doing here is you're looking at the compound curve because the next time you borrow, let's say you put in $10,000 for the first year and you did your whatever refinance and things like that. The next year you'll have like $20,000, $30,000 the third year, fourth year, because it keeps growing and you're also putting money in cash back, cash inside to grow it, just like how you would with your house, right? We look at the house in the first few years, we're actually paying more interest than we are with equity. But as time goes by, we're actually putting more equity into our house and building more of that cash value so we can loan it out and do a HELOC, what we need to do. So this is really one of those big solutions that we can say, hey, you know, we can basically have that life insurance working for us as well as our real estate working for us as well. So now we have compounding, making our money work twice. It's actually working for us in many, many ways, because now we also not just have 2 assets working for us, but we also have an estate plan. We also have tax deductions. We also have velocity of money. We also have, you know, a solution for repaying things back. We also have a contingency fund. We also have, like I said, insurance, so we can take care of our families if we need be. So this is one, sorry, give me 1 second. So this is one example. If we did a, sorry, I don't know why, but I should have done a female, but it was just one of those things. Sorry about that. But this is an actual client that did 10,000 a year for 20-year contributions. So they basically took out a 6% interest loan, and you know they got a 50% tax deduction because it's from their corporation. So basically they're out of pocket 3% in terms of their lending on their loan. So let's take a look at year 10. I'll actually show you year 1 and break it down as well in a second here. But if we take a look at here, they put in 10,000 a year, so 100,000. In year 10, they have access to $112,000. So if, oh, geez, if they took the $112,000 and actually have 90% of that loan loaned out, which is $100,000, and then ask for 15% on the private land in 1 year, their return on investment would be $15,000. All the while, this policy also made 6.5%. Take a look at year 20. You did the same. So what the plan is to, if you're a private lender, is to do this every single year. So once you get your $15,000 plus your 100, so $116,000, you're going to pay back your loan and have your ROI, 15,000, put it back into real estate. But the next year, you'll actually have more. So if you keep doing that, take a look at the numbers that you're making. So if you had $400,000 in year 30, I don't know if there's a lot of young real estate investors here, but in their 20s or what have you. But if you had it in your 50s, $400,000, you make $62,000 on one plus the 6% here. It's pretty good. But you also see that the coverages keep going up as well. So therefore, now you also have an estate plan. So what I'll do is I'll actually show you the policy here. And if I can, just give me 1 second. So I have to do it this way. Okay. So if you take a look at here, anyone see that?
We can see it. It's a bit tiny.
Okay.
Can you zoom in a little?
I can zoom it in. Better?
Yes, that's better.
Okay. So we did $10,000 and this person only said, hey, I'm going to only do it for 20 years. After 20 years, I don't want to pay anymore. So you see here in the first year, we have $10,000 is cash premium. And they have access to $8,100. So you're probably thinking, well, why do I only have $8,100 instead of 10,000? See, the reason being is because because of the fact that there's an insurance wrapper wrapped around it, what we're doing is essentially we're taking the real estate or the equity and interest into our policy, this is our interest. This is the minimum amount that you should be putting to keep this policy moving. And this $7,100 is your straight overfunding or equity. So if you're putting cash inside this policy, $10,000 a year, $7,100 is straight equity, and $2,800 is your interest or your insurance. So that pays for $618,000 of term insurance and whole life insurance. So you might be saying, well, I want the whole thing. Well, just like a house, you have to pay the interest first and then get the equity. At least this way, you're getting most of the equity and paying a little bit of interest. So when you put that into this, essentially what we're doing here, even if you did it in year 5, you have $48,000, take 90% of that, put it into a private lend or even your project as say, if you have a project in Ontario, like in Cornwall or something like that, that you can get a triplex for $180,000. Yes, there are projects like that because we're looking at some. You'll only need about $30,000-$50,000 on the second mortgage. Once I do a refinance, I'm going to bring that back. And whatever I've made, I'm actually going to be cash flowing that property. Next year, I have almost $60,000. 72 after that. So it keeps growing, even though you're putting money in. But I think I want to stress this is that even after 20 years, this person stopped putting money in. The policy still keeps growing. And this is just based on the 6%. So now you're looking at $14,000 and you didn't even put in $1. You can borrow against this and make more money on that, pay back the loan, and then do it again. But next year you have $322,000. The next year you have $337,000. So again, I don't know, something that's going to keep growing that isn't tied to the market, that you have access to in liquidity. And it also gives you an estate plan. So it kind of covers all the bases of what we want to accomplish here, which is maximizing our dollars and maximizing the potential of what that money can do is in terms of real estate. So
So, Joe, can you explain to everyone what happens if I borrow that money and I die?
If you borrow the money and then you die,
Mhm.
give me 1 second.
Borrow some of that money and then I die.
So let's say I don't know, year 23. Here you go. So let's say you borrowed money. Let's say you borrowed $100,000. And unfortunately something happened and everything is, you're no longer here. Let's just call it a spade, right? So we took $100,000 and we put it into land or whatever. What happens is, like I said before, you actually don't ever have to pay these loans back. We teach you to pay the loans back so that way you can access more money on your lens and your projects. So that way you can have it because I know I'm going to go on a little tangent here, but for example, let's say you took $100,000, let's say here, right? You took $100,000, right? You still, you have the flexibility to pay off when you want. And so therefore you can do whatever you need to do with it. But if you pass away, the death benefit will actually pay back your loan for you. So in this case, you'd have $994,586 that goes to your family tax-free and pays your loan back for you. So essentially you're covered. And again, because it's contractually obligated by the insurance company, they will do that for you. No questions asked. So like I said, you can pay back the loan whenever you want, or you don't have to.
You do have to pay back the interest, just like a HELOC, but not the loan.
Right. That's correct. That's correct. Yeah.
There's a
But we do stress
question
that.
in here from Ina, Joe. Why does death benefit drop when the client turns 56 and stops
Oh,
paying premium?
thank you so much. That's a great question. I was actually waiting for someone to kind of see what that is. But so how this policy was designed, and again, I stress, so someone who, if you want to take a look at this, please do find somebody that is capable of designing it in different ways, because not everyone knows how to design these things. But what we did here was we actually put a term insurance rider for 20-year term at $500,000 on top of the 118,000. The reason we did this is twofold. And the first one really is we want to be able to cover their gains at this time in the future. So right now, if we didn't have this rider, they would only have $118,000 of permanent insurance. But throughout their working years and their gaining years, they're paying $2,400 for it. If we just added a term rider on here for 20 years, we actually maximize their potential right now, which is $618,000. Excuse me. And you can see that it grows exponentially as well. So at year 20, it's over at $1.2 million. But because of the term policy, we didn't renew it at age 56. It goes down to 757. But that again, they're 55 years old, so they're going to be going into that different stage of retirement or what have you. So in that sense, it's going to climb back up at age 75. So essentially what we did was we want to be sure that we're covering them for a high amount in the first years. So that way they're secure and it's peace of mind, and they don't have any uncertainty. But also in later years, we have the same amount as well, because we know what the taxable gain is going to be. So that's why we did it. Hopefully that answers your question.
Oh, there's another question from Ina again. Does this rider contribute towards total death benefit growth? And what would this look like if there was no rider?
If there was no rider, so if there was no rider, they would only have the $118,000, and that's going to grow. So essentially it's going to grow a little bit. So what we also did here, I don't really want to get too technical, but I will in a second for a little bit here, is that the CRA is aware of this. They're not oblivious to this strategy. So there's something called an MTAR line, which is basically kind of the max contribution that you can put in to a certain amount of insurance. So the ratio of insurance and cash value that you can put in can't exceed. And if it exceeds, kind of like a TFSA, you're offside. The insurance company will give you the premium back, but essentially you're going to be offside if you keep doing it. So what we do here, because it's only $118,000, with this term rider, we can actually lift that proverbial TFSA limit to a very significant amount. So if we didn't have this, we'd be looking at possibly another $3,000 or $3,500 in accelerated deposit options or equity. So therefore, because we're putting this in for very cheap, we can really just bump that maximum contribution up. So that way it's $10,000. So that's what it would do. So to answer your question, yes, it would be significantly lower than $600,000. So if you take a look at everything here in the growth, just minus 500,000 on each. Hopefully that answers your question.
Joe, so can you let it, remember we discussed about using me taking out on my son? Can you tell them that kind of
Right. Yeah.
idea, or the
Yeah.
when it comes to us old people?
So there's two ways that we structure it. One, we can actually do, again, it all depends on the planning that you want, because some people, like for example, I'm doing a plan right now for a couple 77 and 76. And they have 5 investment properties. They also have land, as well as about $650,000 in another company for marketable securities. The tax that we're going to have actually on the second death, not the first death, because there's something called the Section 70 of the Income Tax Act, which is a spousal rollover. And so it actually goes to the second spouse who's living tax-free. A lot of the even your pensions roll over, right? So it's a spousal rollover. It's within the Income Tax Act. But on the second death, what happens is there's going to be a huge tax bill. It's actually going to be about $600,000, right? Because we don't expect them to die at age 78, probably about age 90 to 95. So therefore, we want to be able to take care of that. So we do a joint last to die policy. So that way, for one, we can actually take both ages, push them in a blender, and actually have a lower age rate. So for example, this person would be, I think it was like 63. So we dropped down through 10 years just by doing this type of structure. But what Debbie was alluding to is that for people that are on a more mature age and saying the insurance is a little bit more expensive, so that 2,800 would probably be double, like 5,000, and the cash value would be a little bit less. We say, well, do you have children? Because if you have it under your children, obviously they're a lot younger. So you see that this person is age 35. So we could actually put it under them. But the great part is you actually have control of this policy. So remember that word again, control, because you as the owner of this policy can do whatever you need to do with it. So you can borrow against your kids' policy. So for yourself, Debbie, you can put it under Ryder, put it under Brandon, and say, I'll pay the premium, but I'm going to be using this policy, just letting you know. And when the time comes, you have the ability to actually transfer it to them tax-free. So they'll have the ownership, And would they have to buy insurance? No. But again, I think one of the things that people look at is that, okay, it's an insurance policy. But if we're looking at it from an infinite banking concept, we're actually not looking at the insurance that much. It's just an added bonus. We have to find the right number so that way we can take care of the estate. But the most important part is that cash value. So I think that's something that we should be talking about, is that we should be taking a look at that cash value and how we can actually access it when we're alive. Because a lot of people look at insurance and say, oh, I have to pass away for me to, or actually, I can't even access it. My kids will access it because I have to pass away for the benefit to kick in. And where, as we're just alluding to here, we can borrow it when we're alive. We can use it when we're alive, and we can actually make money on top of what we're making here when we're alive. So even if you take a look at it on a conservative basis, it's making like 10 grand, 12 grand, $15,000 because you're putting 10,000 in. I don't know, you can't lose, because there's also guaranteed values that are inside as well. Not going to go into that because that's a whole convoluted equation, but take a look, just take a look at this, which is the cash value. But I would stress, if you think that if you can take advantage of putting a policy on your child, you actually guarantee their insurability, so they don't have to have insurance later on, but also they'll have a bank on their own. So especially for newborns, man, you do a lot of newborns. So some people do a blend of the RESP and insurance policy, or they'll just go straight to an insurance policy, because the insurance policy is very flexible in what you can put it in. So you can put it, some people say, hey, we can use it for a business. We can use it for a real estate property for them. We can put it towards their education. We can put it towards so many different things. And where the RESP is good for one thing, which is school. School is important to you, RESP is the way to go. I'm not going to say it's not. It's the way to go. But if that's all you want to give them is a piece of paper, and then they have to go line up at the job fair after with their diploma, all to you. Fantastic, right? So this way, you just have more flexibility on what your kids can use the money for. I don't stress it, but they can even go on trip if they want to, have some life education. So.
But Joe, this policy, the premiums on here are more than on a regular term.
Oh, definitely. Definitely. Yes. And the reason being is because of the fact that we're insuring you for life. So it's not just for a certain amount, like 10 years, 20 years, age 65 or whatever. Term insurance is one of those things where you are renting your insurance. So if you're renting your insurance, it's only good for a finite amount of time. Every 10, 20 years, it's going to go up just like rent does. And so it's not inflation, it's just because you're older, right? You're 10 years, 20 years older. And by the time you're age 80, they're actually going to evict you because of the fact that you are
You're too
old. Too old. I'm trying to be nice, but you're just gonna call it what it is. Right? So, but
and then you also have to get medicals again and things like that for the term, once a term.
Not for the
Not
renewal.
for this one.
Not for the renewal. So when you're renewing, it's convertible. So therefore it can convert to the next stage. So if you're doing, let's say you do a 10-year policy, I'm 44. So if I did a 10-year policy, and then when I'm 54, it will automatically renew, but at a higher rate. And then it's going to do that every 10 years. And so that's okay if you need the coverage. But I stress, can you use your policy, your term policy, for a financial opportunity like real estate? Can you put it towards a retirement plan that's a top up? Can you put it towards a private lending deal? Can you put it towards a land deal that I know someone in BC that, might need something, right? So, there's so many different options that you could put it in. And I look at it as, if you can think about it as an insured bank account, that's really what this is. It's an insured bank account that you have access to. The only thing is, we don't want you to take the money out because we want you to borrow against it. So that way you can capitalize on the compound interest inside the policy. That's really what it is. Okay.
And you
So,
can't earn 6% on your bank account, and you
nope.
can't take, when you take out money, the interest you're earning is reduced. And in this case, it isn't, because
Right.
we're borrowing from it, but it doesn't actually reduce the value.
Exactly. Exactly. So if we can, again, use our money twice, 3 times, 4 times, we're actually making more money on top of that as well. Okay. So,
And I think, Joe, I mean, there's so much more to this. So they really need to, it all depends on the person and the circumstances. So they really need to work with someone like yourself to figure out what it is they want out of it, and, their circumstances that they
right.
need.
Exactly. And honestly, I'll be honest, just to kind of finish it off here is, can we see that?
Tiny, because it's not
Tiny.
in present mode.
Yeah. Okay. So what this basically says is that standard deviation I was saying. So if you take a look at the what the S&P gave in 30 years time was 8.84, and this is 2021, so please bear with me. But it gave out 8.84, but if you take a look at that standard deviation for that 30 years, 16%. That means it's doing this volatility, roller coaster stuff. So that's nice, right? For sure. Like if you say -1 here, then 32 the next year. But let's take a look at the big one that many people looked at was 2008, -33%. And where our insurance policy gave out 7.9%. And in that 30-year time frame gave out an average of 8.02%. But our standard deviation was only 1.44%. So basically, what is comparable to a 1.44% of risk is a money market fund or GIC, like GIC, very safe stuff. So what we're getting in terms of return is way better than a bond, way better than our GIC. It's comparable to equities. We're getting equity returns at very, very safe investment. And the best part is it's tax sheltered. So the account grows on a tax sheltered basis. So in order for taxation wise, because this is pre-tax, so 8.84% is actually taxable at half. So it actually has to collect more, at least 12%, to get the same returns as a life insurance policy. So just closing here, if you were to take a look at things, you can either do nothing and kind of do the same thing that you're doing, which is, you making your money work once, have taxable investments and not really smoothing out your returns. You can try it yourself and find other people to do it. That's fine. That's also good too. Or we can have a conversation. So it's really, the ball's in our court. So again, how would you feel if you implemented a strategy inside your corporation or even personally, where you can have tax sheltered growth inside your corporation or even personally? You also have access to the money, which is liquid. You have an unstructured loan that doesn't go on your credit score, but you can have the ability to pay it whenever you want to. You also have a no credit checks or no debt service ratios on that. You can actually put it into another asset that grows more. And also it gives you the ability to have an estate plan so that way your kids can enjoy the fruits of your labor, which is 150 doors that you have in the next 5 years, based on what Heels on Fire can do for your coaching, right? So again, if you have good cash flow, if you have, you're doing savings or whatever it is, it's really just a mindset and a switch on what you can do with your money and what the possibilities are really. So thank you.
Awesome. Thanks, Joe. Can you pop in the chat your contact information for everyone? I
Sure,
will send out, you'll send me the deck, and so I
definitely.
will send it to everyone. So if everyone is on, if you're not already on my distribution list for getting Heels on Fire in your mailbox,
Oops.
I'm going to pop it in the chat again for those that joined later. Do put it, if you're already signed up for it, you don't need to do it again. You're already on distribution list. If not, sign up now, and this one will come in along with any other sessions that we have. It'll come automatically to your mailbox. Yeah. So, and then if you're in BC, Alberta and Ontario, Joe can definitely help you. But I'm sure, Joe, you will talk to other people that are outside the provinces to help them understand. Some
Definitely.
of
We
this.
are actually looking at licensing in various other provinces as well, just because we are getting a lot of feedback and a lot of inquiries about it. Like I said, we're not the only ones on the market, but the thing is, we look at it from a real estate point of view, and actually more importantly, we look at it from an asset point as opposed to the other way around.
Mhm. Thanks, Joe. I'm just going to wrap up a few details, if everybody could just bear with me. Just a few public announcements. So for those that missed the 7-day challenge in August, I am doing a second one. Or if you signed up but weren't able to make it, there is another one. I got very good reviews from those that did the 10. Like Liz said, I can't thank you enough for graciously sharing your experience with us. It added a ton of value, and you're very inspiring. We've got Janet that said it's super helpful and informative. She was even seeing that other investors that on the challenge were really like taking action. Cheryl said that she was stuck before taking the challenge, and then now she's unstuck, and right away she's already connecting with many investors, and she's doing, you even did a live event that she went to. So I encourage you, it is free, so take advantage of it. I'm going to let me move this out of the way here. I'm going to grab the sign up and pop it in the chat. So it's September 18 to 24. It's 1 hour, from 18 to 24 every evening. So 7 p.m. Eastern all the way to Pacific at 4 p.m. Pacific. So let me just pop that in the chat for everyone on the Zoom, and then I'll pop it in the live after, because don't have enough screens to do all of that. So am I sharing? Can you tell me if I'm sharing or not? Am I sharing the 7-day challenge? Can you guys see the
Yeah.
screen? Okay. Because I've got stuff everywhere. So that's in there. So yeah, so it's all about, it's about getting you optimizing your social media presence, leveraging other people's Facebook ads, leveraging, showing you how to do it in LinkedIn also, how to build that network so that you can attract quality investors. So whether you're an experienced investor, and to help you just level up there, or whether you're new, like if you're new, that's even better, because then it starts you off on the right foot. So we've got that. Next week we have Alex here. She going with that theme of leveling up in your investor pipeline. So Alex will talk about how investors can build relationships through social media. Alex is a brand coach. So, and she's got a great offer right now. So she will be able to share that offer with you guys. that she's offering a great discount on her program that she has. So, and for myself, right now I have an accelerator founders program at 50% of the regular price. And then if you do it as part of a discovery call with me, or you sign up as part of the challenge, you'll get an additional $1,000 off. So because this is my private my pilot program, and it includes one-on-ones, coach in your pocket, which means getting in touch with me in between sessions. It's mindset, productivity, and real estate, and it's to help you find your personalized real estate investment strategies. Because a lot of times what happens with us is we know all this information about real estate, but how does it apply to me? Which one should I do? So there are two syndromes we have. We have the shiny object syndrome, where we're try this, try that, try that. No, that's not me for me. That's not for me. And we kind of lose time and money. Or we have the, you know, analysis paralysis. It's just too much. I don't know where I fit in. So I'm stuck and I'm not going to do anything. So that's what the program is all about. There's lots of great things happening. And so if you're interested, reach out to me and book a discovery call. And I will pop that discovery call link into the chat. And then we can talk more about whether it applies to you. It doesn't necessarily apply to everybody. So, we'll, through that discovery call, we'll find out whether that will work for you or not. So let me grab that and pop that into the chat. So, and that is it for today. Any last minute questions for Joe before we wrap up? No. Well, awesome. Thank you all for joining, and be back next week. Same bat channel, same bat time. We'll see you. Thanks, everyone.